All right, all right. What's going on, everybody? It's Friday. Come on, you know you like it. Hey, how you doing? So I had a list of topics I want to hit on today, but there was also a topic request. We're gonna start there. Today we had a move similar to a liquidity gap, and I had made the comment when price was moving up into the liquidity gap area to be careful, right? That's really all I had put out there. Be careful. It looks a lot like a liquidity gap, and that means when we get there, we might end up reversing because we just closed the gap, so to speak. And there was a comment and a request on explaining this a little bit. To explain this, really the getting it from the horse's mouth, I guess, would be a good way to do it. There is two main companies out there that deal with liquidity. One is Bookmap and the other is Jigsaw. Uh, They're not that far apart, really. When you look at the tools that they offer and what it is that all of us is looking at, what we're trying to see, what we're trying to understand is the activity of the participation of those who are trading in the market. Now, one thing that I think all of us forget from time to time is that when we're trading the futures and really a lot of other things too, but we'll just stay on the futures for a moment. Retail, you and I are likely speculating. We are getting in and we are getting out because we have an idea that price is going to move up or it's going to move down and we want to make money in that move and we think we have a bias that is accurate enough to risk money on. And so we guess, we assume, we analyze, anticipate, and we take a trade because we expect the market to move. And in that move, we're going to make money. Most of the money that's traded in the futures is not doing that. They don't have a vested interest in whether it is going to move up or down during the time that they're holding it. They're not getting in it speculating on a move. They're not anticipating a move. They're not reading into a move. They have no technical analysis that tells them it's going to go up or go down. Right? I really got to hammer this home. Their entrance and exit is not based in any way on the idea that I got in here and I want to get out over there because I'm looking to make money in this. It's easy to forget that logic because it's what we focus on all the time, but it's not what big money is focused on. It's not even their goal or their purpose. So when you see price moving, it's easy to say they want this, they're doing that, but they don't have that vested interest. You do, I do. So don't put your bias onto the market, right? Because it's one of the easiest mistakes that all of us make. We think the action that we're seeing in the market is because other people are bullish or bearish. And sometimes that is true, but a lot of what is moving the market isn't because of a bullish bias or a bearish bias, and it's not because of speculation. So just keep all of that in mind. So over the years, tools have been developed to help us analyze the activity that is happening that makes price move. A little bit of a Captain Obvious statement. If nobody trades it, it won't move, right? It's Captain Obvious. So there has to be a buyer and there has to be a seller. Without both parties, the market can't have a transaction completed, and with no transaction, the market won't move. What we have to try to figure out is who initiated the order. Did a buyer reach for a seller and a deal was made? Did a seller reach for a buyer and a deal was made? When that activity takes place, we want to analyze it to try to anticipate how aggressive was that buyer or how aggressive was that seller, and are they alone? Do they have other market participants who are trying to take the same trade, and or are they fighting against another group of participants who are trying to take the opposite side of the trade? We can use these tools to analyze that. Bookmap and Jigsaw both have a lot of material, a lot of education. If you was to go to their website and or if you own their product, they lay it out really well. What we want to focus on is the very first lesson that they offered over at Jigsaw that talks about the structure of the dome or the active trader if you're on Thinkorswim. Different places call it different things. The ladder, the dome, the active trader, doesn't really matter what you want to call it. I was looking for an image. I could have swore I had just a very basic ladder image, and I'm sure I do somewhere, but I'm not running across it at the moment. But the idea, we'll just use this one. You can see on one side, we've got a list of market participants, and on the other, we've got a list of market participants. Now, these aren't trades that already happened. These are people that want to get into the trade, right? So we got the buy on the left, and the sell on the right. In this scenario, we're on the sell, right? There's not even a gap, but sometimes there will be. When I reference a liquidity gap in the scenario of today, for an example, when we shot up really fast, all of these numbers on the left-hand side got left behind. Now, sure, there'll still be a number because there's always a number. So if we shoot up 50 points, if we went from 1166 to 1216, there might be ones and twos left behind on the left-hand side, but there won't be all of this, right? That's what 60 and 60 is 120. That's 208. That's 246. Just with those four strikes right there, plus another 280, you can see there's a lot of orders there, right? Combined, that's about 600 orders or 600 contracts that are resting below price and acting as a floor. If we shoot up really fast, there's no structure underneath price and it can fall back down really easy. In the scenario of today, when we shot up really fast, we created that sort of liquidity gap. But what's different though is that we also fell back down really fast. Right? So we left this wick behind. And the concern was when we got down here and we closed at a half, first, price did go down here and it closed that gap. And that makes sense because that's where the whole move started. My concern was that we had abandoned a lot of traders up here. And on the fall, we left another gap. We actually didn't have a ceiling in place, which meant we needed to go up and close that ceiling. So when we think of that, all these numbers on the right, when price fell back down and left that wick behind, we didn't have all of this weight against the top of the market. And we had abandoned some position up there. We needed to go back and get it. Now, if you're new to trading and you're hung up on, but how is it moving? And don't do that. Don't get hung up on the semantics of it all, right? Just keep it vague enough for your mind to wrap around the idea that above and below price at all time is market participants. And if we move too fast and we leave them behind, it leaves a void, and that void needs to be filled. And more often than not, it does get filled. Need isn't necessarily the right word, but um, the lack of structure underneath price means we're very likely going to fall back down again. And the lack of resistance overhead, for lack of a better word, the lack of all of these participants over our head means that we'll go up a lot easier. If this was really thin and these were ones and twos and threes and ones and twos, if there was all these guys trying to get filled and there's nobody over here on the other side to help them get that fill, what do they have to do? They have to reach higher, right? So if there's only one contract and 15 people want to move up, then sure, one person got that order, but then everybody else is going to have to reach up. So maybe there's two here, maybe there's two here or three here, and then two here, one here. It's really thin. So if there's an aggressive amount of people that want to come across, they have to keep reaching higher up the chain to find somebody willing to sell them something. And that created the liquidity gap. Maybe it shouldn't even be called a liquidity gap because it wasn't the same, right? And I tried to say that, but I was in a hurry too because I didn't want to miss out on my trading. So in my announcement, I just said it was similar to a liquidity gap. But that is the logic of a gap, is that there is a lack of liquidity, because that's what these market participants are. They are liquidity. So a lack of liquidity means there is a lack of market participants. We ran so fast, we left them behind. And so, of course, we often will retrace because of that. And that's what we saw today. Cool, cool. All right, let's see what else is on the list. So I've been looking at ETFs that represent software because of the software destruction. There's actually a phrase that's being used right now, and I want to start using that more. What we're looking at here is a website called Macro Micro. I love this site. They always have really good articles to read. And they talked about how the market was changing into a different model type. And even how we're looking at AI is changing. When AI was really in the growth phase, we were building out infrastructure and all of that. The prevailing view, this is their words, and I love this. The prevailing view positioned AI as a software industry catalyst, that it was looking to expand addressable markets and enhance productivity, which sounded fantastic. And the software really exploded because of that. But recent demonstrations have shifted the sentiment towards viewing AI as a potential destroyer of software business models. That's what has changed, right? That's that fundamental shift in how we view AI that's happened really since October and November of last year. And to hammer that home, look at software ETFs. So we've got IGV for an example. This is IGV. Let me bring it up on another grid. This is IGV. Now we want to go out to a daily, and you can see since November, when we had this sort of double top scenario, we've been working our way lower ever since. And it seems like we've stabilized around $80. That's not a 50% haircut. Um, it's a 25% haircut, I think. Sounds about right, math wise, from 120 to 80. So it's a kick in the seat either way. And now we're building a bit of a base. Maybe we're going to break down from here, maybe not. But that's the destruction that we've been seeing. Look at it on a weekly. This is a 3-year weekly. And we can see that same work, right? From 120 down to 100. 100 didn't hold. We went to 80. And it's funny that we went to 80 because there's a bullish phrase in the market that says, if 80, then 100. If you can hold above $80, the market more than likely is going to swing trade up to $100. And of course, the opposite is true. If you fail to hold above $100, it's likely you're going back to 80. And sure enough, that's exactly where it went. It's kind of cool when you think about it, unless you're the the one running this market, then it maybe not so cool. So if we fail 80, then we're going to 40. Yeah, that kind of sucks, right? But that's the number. They say if 40, then 80, if 80, then 100. I don't think it's going to get that bad, but I mean, who would have known, right? Because I don't know, say back here in October, who thought we were going to 80. So, there we are. Now, this grid is one of my old school grids. What we're looking at here is my ETF grid. The ETF that we're looking at is IGV, but you could put any ETF in there. And then depending on how much view you want, you can put in your top 8 or top 10, top 12, because you can put as many charts here as you want. I've got the top 10 names in this ETF, which the way I run it in mine is this is number 1 and this is number 6. So it goes across this way and then it goes across this way. So this is number 10, right? This is number 5. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's the way I read it. So the smallest one by market cap is Now, and the largest one is Microsoft. And that's the weight that these have inside of IGV. That's the way I should have said it, not by market cap. It's their weight within this ETF. Microsoft has the largest weighting in IGV. I like looking at ETFs this way because sometimes I might want to trade app or Adobe or Microsoft, right? Sometimes that's what I want to do. But sometimes I look at the market I want to trade and it has bad options, poor liquidity, earnings next week, something that makes me not want to trade that particular market, but I still want to trade my bias. And so I focus on one of its peers or the ETF with the largest exposure to that particular name. And this grid is a nice way to do that. Now, this is an intraday grid. Usually I build them out to where I have the intraday and then I have a daily version. And then, of course, you just name it so that you can check it out, right? So IGV, IGV daily, ITB, ITB daily. You get the idea, right? And you can build out as many of those as you want. It's kind of nice. Of course, you lay out your ratio charts and that sort of stuff too. So if you don't have this grid, you can find it in the Thinkorswim workbook, or you can just build your own. You won't find the IGV itself, this one particular grid in there. And that's because the weights change every quarter. Palantir and Oracle might shift places, or Intuit software may be number 10 in the list. So it's constantly changing, but this grid and the format of it, you can find that in the workbook. If you want this particular one, then I'll just share it in the chat. But remember, they will change next quarter, right? Because that's just how it works. So there's a significant amount of destruction that's going on out there in these software names. And the scary part is we don't know where it's going to end, right? But if you look at those names that are the top names, the top holdings in here, only one of them was one of the Mag 7, and that was Microsoft. And Microsoft is in a unique position that one, it has a boatload of money, but two, it's diversified enough to be one of the companies that will be offering agents. So those companies that are offering software that AI agents can easily replace, oh, they're screwed, right? They don't have the money, they don't have the moat space to protect them as a company, and AI is just going to eat their lunch. But for those bigger companies that can become a part of the model that works with agents, they'll be just fine. Microsoft is one of those. As for the others in this list, maybe not. Yeah. So finding articles that dig deeper into this is something that you really want to focus on. This article is one that I've shared before. If you haven't caught it in the chat, I can share it again. When returns meet reality, tech's monetization doubts. And it lays out what the market is looking for next, right? We went through phase one, which was the infrastructure build out. We are wrapping up phase two, which is software and platform build up. And we're transitioning out of phase two and coming into phase three, application and monetization. Now, don't get me wrong, this is really new. And so we are still looking at a lot of companies working on phase one. It's not like there's nobody doing a phase one. Of course, there is. And there's companies that are barely transitioning out of phase one and just getting into phase two. But a large part of the market that's moving in this space is working on transitioning from two to three right now. It lays out this phase of the AI product cycle in this chart here. I thought they did a pretty good job. And then it kind of brings it all home in the lower part of this article, which, like I said, I'm more than happy to share it. Not a big deal. But those companies that have spent radically on AI and they're not showing any profit from that yet, they're going to start to get punished. And then companies that are exposed to AI taking over what they do are at risk. They had some good examples of those companies. Let's see. Unity, AppLovin, and Intuit was three. Oh, and ServiceNow. Those companies have just gotten their butt kicked. And then, of course, there's these legal companies, which I don't know. Thomson Reuters, Relex, and LegalZoom. Those guys were charging a boatload of money, and now AI can do the same thing for $100 monthly subscription. Yeah, those are the kind of articles you really want to latch onto. Read them, absorb them, understand them to their core, right? So that when you're moving forward from here on out, you have that as a backdrop. Because it's not just what we see in the candles, right? Every one of these companies is going to bounce. They're going to move to the upside. It's not a straight shot down. So we don't want to be one of those people out there that thinks, oh, software was just weak because of whatever, and now it's headed back up, and we're going to buy the dip. And don't do that, right? Because it's not looking good. Yeah, they're going to bounce. Yep, they're going to move up. There will be some long trades, but stay nimble. Don't think, that we're going to run them back to their previous highs and all that good stuff, because we're very likely not going to get that sort of market participation, right? It's very likely going to run up into a resistance level and then turn and fall down even more. Yep. So this won't be the last of it, just like that one wasn't. And this isn't the first time that I've heard about it. It's just they did such a good job with this. I wanted to bring it up. Continue to focus on these kind of articles that help keep you informed and better understand the current phase of where the market is in that cycle, so that you have a better understanding of the trade opportunities that are around us, right? That's all I really wanted to lay out. There are going to be long opportunities that we're going to see in the chart from these names and other names. And of course, if you want a short-term trade, jump in, take it for a spin, but just don't get married to the idea that we're headed back to the old highs in that software name. Well, we managed to get to the ADR half, and so far we're still range bound. It's likely that that's all we're going to get. Maybe we'll get a little bit more. There's still time left in the day for a headline to spark a move up or down, but getting the ADR is what we're supposed to do on a day-to-day basis, right? That's our average daily move. So, cheers, we got that. I don't know when the president is going to speak. I seen somebody shared a link earlier. I poked myself around on Market AI. I didn't see a timestamp for when it's supposed to start, but if he hasn't spoke yet, we have that risk. And until he's done speaking, okay, good. And he's done. He's over. Then we've got that risk out of the way. So that just leaves us with a boring, sleepy Friday into the close. It's about as much as we could ask for, I suppose. Now, yeah, there was a lot of back and forth in the legal space, who had made it clear that if this current tariff regime was kicked back by the Supreme Court, that he had multiple avenues to still continue to run this tariff regime. It's just not going to be as freewheeling as it was. He was taking all license upon himself without having to ask Congress or do any check and balance. And with the other types of tariffs, he may have to submit it to the House, the Senate, ask permission, get majorities, and of course that's going to slow everything down, and it's just not such a one man band, so to speak. So he does have other avenues, which of course will also be challenged in court. And yeah, right now the market just wants to know, how are we going to get our money back? And there's already been a couple of firms who have begun the negotiation process for pennies on the dollar of getting some of their money back. What a shell game, right? What a mess. All right. So, another thing I wanted to talk about today, it was on the list, is mechanical options trading strategies. I'm a big fan. I've done a lot of work on this over the years. They are adaptable. They're none of them are set in stone. Sometimes they quit working and you have to come up with a new model. The hardest thing is proving that they work. And of course, with a little bit of extra legwork, you can always trade them in paper or live, like I did back in 2020, and just put your money out there and see how it goes. One of the hardest things about mechanical trading is to stick with it, because every instinct in your body is going to tell you, no, I don't want to do it this week because whatever, right? FOMC, war, bad news, whatever. When I started my first mechanical trade strategy, I employed a number of them all at once. I didn't just choose one. I put together multiple strategies. And at the first of the year, I was going to put them on. That was my plan. I just didn't know at the time that the first of the year was the year of COVID. So you can imagine my surprise when everything started to go to hell. And here I was trying to run a mechanical trade strategy. So in January of the first of the year, I employed my strategy, and the market crashed down starting mid February. But I did not stop the strategy. I had to adjust some of the rules because things got too expensive in the options market to meet my criteria, and so I had to adjust some of the strategies. And the market has altered itself since COVID, which has broken a couple of my other strategies, but they weren't a part of the mechanical system back then. So they didn't stop me from doing what I was doing. Anything can become uh, a mechanical system. The phrase mechanical is supposed to imply that by rote you're going to do a particular thing, and that it's not based on your analysis or emotions or anything else. It's these criteria have been met, and that is the checklist for me to put this trade on, and it's going to get put on. And that you don't pick and choose when to do it and when not to do it. The conditions are met, you put on the trade. This does not have to be complicated. One of my conditions was, is it Tuesday at 11 or between 11 and 12? Because that was one of my mechanical trades, was to buy a call every Tuesday between 11 and 12 o'clock. That's it. How easy is that, right? And believe it or not, that strategy paid me money. And it wasn't based on anything else other than, hey, it's Tuesday between 11 and 12. It's time for me to buy that call. And I went in and bought a call. That's nuts, but it worked. So, mechanical systems don't have to be complicated systems. Of course, I had criteria to it. No, when I finished at the end of the year, I stopped doing all of them for over a year. It was a stressful year to say the least, especially considering, what happened that year. So many people that had died. What a mess. Um, No, I got to the end of that year and I shut them all down. Now I still individually trade those trades, but not mechanically. I still randomly pick and choose now when I want to do it. And that since I'm choosing to do it, it's not mechanical anymore. But I proved that every one of them worked, which was the cool point. Maybe if I had only done one at a time, it wouldn't have been so stressful. Or maybe if it hadn't been COVID, it wouldn't have been so stressful. But I was running a lot of them and it was a rough year. Now, the reason I'm on this particular chart is because it is showing my weekly expected move. The red, green, and gray lines is 1 week from Monday to Friday, and the gray line is the previous Friday's close. So we'll just zoom into this week since we are on Friday. And we can see that the gray line is trying to keep up with where the market is. It's a little slow, but there it goes. It just shifted. So all three of these lines are moving up and down, and they're going to continue to follow price all day. And after the close this afternoon, they will lock into place and they won't move anymore. So when I look back here and I see this gray line, I know that's where the close was on that Friday. And then the new week started and we had a week of price action. And this was the top and the bottom range for the week. It was the weekly expected move. Now these are locked in place on Friday. When I go over and look at the options market, and any broker that offers options should have this data, right? I can't think of a one that has options and does not have the implied volatility average. It might not be in the same location as this broker, but it's these numbers here on the right hand side. That's the average implied volatility average. So because of the options that are being traded, how heavy they're being traded, how fast, the size of the trades when the trades come in, all of that affects the different strikes, and each strike has its own implied volatility. So what this is doing up here in the corner is it's averaging all of the out of the money options on the put side and the call side to give us the aggregate average of all of those options for that particular expiration. And then what that tells us when we look over there is how far is the market expected to move, and or what is the range that the market is expected to close within. And that's our range model, right? So this is a 3 days to expiration and it says $60.92. Well, it's the ES. We don't get to move 92 cents, right? So we can look at that and say 61, just round it up. 61 points is the 3-day range. Within the next 3 days, we could move up 60 points, down 60 points, but we're likely to stay inside of that 60-point up and down, which is 120 points total. We're likely to stay in that range, and we have a 70% chance of doing that. We might poke outside the range and yet still come back in and close in that range with a 70% accuracy. It's a 1 standard deviation range. So that's cool. If things get a bit extreme, we can use that number too. So 60 might be the default, which says, yeah, if things were normal, 60 is what you got. But I can use that number and say, but what if it gets wild? What if we get some headlines? Then we can take that number and double it. So now we're looking at 120 to the upside and 120 to the downside. And a volatile week could move 240 points from top to bottom instead of 120 top to bottom. So this number is not just good for if things stay normal, it's also good for what if we fall the hell out of bed. If you notice, the number is moving while we're sitting here talking about it. That is a dynamic number. It is constantly moving. And if you want to know the distance we could move over the next hour and a half, then you could look at this one that's going to expire in an hour and a half because it's alive. It says we can move 15 points up or 15 points down before the day ends. Every single day, you could go in and get that sort of measure and apply it to your daily market. Imagine that, right? Because we can run a formula for whatever we want. The next 15 minutes, an hour, a day, week, month, year. But the thing is, these numbers are moving. In the chart we was looking at, it was not moving. They're locked, right? These are static. They lock into place and they do not move. So as we get really close to the end of the day, you could go in and you could mark those numbers for yourself and trade those numbers before the close. Even though they're still moving, they're as close to the close as you could get, right? Like 350, 355 in the afternoon, you could go in there and you could trade next week's levels. Even though the market isn't closed yet, it'll be close enough because that's what they're doing. These levels are measuring market participation within the options. Now, ES has options, but to be fair, SPY and SPX has a whole lot more options. So since we're talking options, I'm going to swap that market from the ES to the SPX because it just makes more sense, right? So the market participants for this product are gauging and participating in next week's options right now. It's 2:45, so maybe not now. Give them another 45 minutes, right? That'd be 3:30 in the afternoon. They're going to start hitting it even more, but they are the ones building out these levels. So we can trade on their bias. That's what the lines are for, to tell you where you might want to put your positions. Butterflies on these levels are really awesome. It has a high chance of success. The problem is, which side do you put the butterfly on, right? Because think about it. You can put the butterfly on the top or the bottom, or hell, you can put one right in the middle if you want to. And you can do it for one day every day. You can just do one on Fridays and you can do them in advance. What we used to do back in, say, for an example, 2020, when I ran this mechanically, I did not have Monday, Tuesday, Wednesday, Thursday, Friday. They didn't exist back then. What I had was Monday, Wednesday, Friday. That was enough. Remember, the name of the game is occurrences. If I only do one a week, I'm going to get 52 trades a year because there's 52 weeks. That doesn't really work much for the averages, right? We want hundreds of trades so that we can hit that statistical average. But the problem is, which side should we trade? When options used to cost $5 per contract, this strategy did not make sense. You would lose more money just from the commissions that you had to pay than you could make on the winners that did win. So it wasn't a very good system. But now you can trade options for free or really cheap. I mean, just really cheap compared to what it used to be. Imagine that, $5 per contract. That's what we used to pay to put on options trades when I started. And before that, it was worse, but I wasn't trading when it was worse. $5 was bad enough. I was so excited when I talked to Thinkorswim into letting me trade for 2 something a contract. Thought that was fantastic. So you want to get a broker that offers um, low commissions or zero commissions, like Robinhood or Webull. Those would be good ones to pick, except there's some issues we still need to talk about. And then you pick a side. Technically, you could pick all three if you want to. Pick the top, pick the bottom, pick the middle, and then you put them on. Now, you could choose to put them on for tomorrow, today, or you could put them on in the morning tomorrow, right? Which causes 0 days. That affects PDT. So if you're in a smaller account and you want to avoid PDT, then you put the trade on today and you focus on tomorrow, next week. It takes a little bit of effort to find trust in this strategy, which is why I zoomed in here. I put a couple of years on this chart. We're looking at 2016. And what I wanted to highlight is how often price closes on one of those lines. Do you know how much a butterfly in the SPX will pay you if you bullseye with a 5 cent cost? Because you can't get a butterfly cheaper than 5 pennies. That's just the SPX, right? It's the way it goes. So the smallest butterfly you can get is going to be no less than $5 per trade. And it's $5 wide. So if you max profit that thing, technically you won't get $495 because you need to close it before the end of the day. But you can get 480, 470 for risking $5. I talked to a Goldman Sachs analyst who said in 20 years he had never hit a bullseye. 20 years. I hit more than 20 in 1 year. That dude is obviously not doing it right. He should be a member of the Bullish Bears. Maybe he'll learn something. These trades will pay you exponentially whatever you're risking, but they don't have a high win rate. I circled one here, but how many weeks went by without closing on the red or the green line? 3 entire weeks. Now, this looks like a short week, but so what? We're going to just call it a 5-day week. That's 15 days plus a little extra before we finally got one that closed on the line. I got to tell you, when you trade a strategy that loses 92% of the time, it sucks because you just lose over and over and over and over, and you still have to wake up and do it again. You can lose 15 times at $5 a shot and hit one for 450. You're going to be in a better position, right? The idea is you need to win. If you start playing this game, don't stop until you win at least once. Which means if you can't handle losses, don't even start. Right? So this strategy, if you was to run it constantly, has better than an 8% win rate. The average butterfly has an 8 to 10% win rate. At the end of the year, I ran my numbers and I was hitting close to 30, which means I had more than increased the win rate by 200%. I was really impressed with those numbers. 30% win rate. Not quite 30. It was close, but not there. I just want to round up because it makes it sound like I did better. I got to get something out of it. I was close to 30, which is pretty awesome considering, it's supposed to win like 8 to 10% of the time. I haven't yet found a good way to choose which side to trade other than when we are in a bullish backdrop, you want to choose the upper one more often. and we're in a bearish backdrop like 2022, that whole year we were bearish, you want to choose the lower one. But when we're in a market like we are right now, it's so wishy-washy, you don't even have that edge, right? Because some weeks we're kind of bullish and then some weeks we're kind of bearish and we're just kind of and it's not really helpful. So there's no real good way to choose, should I buy a butterfly on top or on bottom? Depending on your broker, you can put butterflies on both. And then if we close in the middle, you can rip the two butterflies apart and you'll have yourself an iron condor, which is cool because an iron condor needs price to close in the middle. I have done that with Thinkorswim, but when I tried it on Tasty Trade, I kept getting a fail error and I didn't get it done. Maybe it was user error, right? Like, simplest solution is I screwed it up somewhere. But on the other hand, it could be that they just wasn't going to let me do it. I don't know. I only tried it once and then I didn't try it again because it doesn't happen like every week. So you have to have the opportunity there before you can try to make it work. And now the range is so wide that even if you was able to pull it off, there probably wouldn't be any profit in there. So I don't even know if that's viable in the current market conditions. So the idea would be that you build the smallest butterfly possible. I like the SPX, but you can use the SPY or the QQQ, right? And now we've got Apple and a few others that have 3 expirations a week. And technically you could use those. I like to use the indexes though, because that's where the hedging is. It's what they're using them for. We might as well take advantage of that. Without their participation, this strategy doesn't work, which is why when I see new models and new trade times like 24-hour trading, guys, 24-hour trading is going to be so awesome. It is going to make these tools even more accurate. I'll take that any day of the week. Yes, please sign me up. I want to see it. It doesn't mean we have to trade 24 hours a day in options. It just means we'll get more data and these tools will be more effective. So you can do it in other products, but I like the SPX. And the smallest XPX butterfly that you can get is 5 pennies. But we have to talk about hitting a bullseye. If you do a 1-day butterfly, say you're looking at Monday and you're going to put it on Friday afternoon. On Monday, that butterfly won't start to get into profit until after 1 o'clock in the afternoon. There's always a chance that you'll see profit sooner than that, maybe because of volatility crush or one of the Greeks is putting some profit into that trade, but never count on that. Just be prepared for it to show no profit until at least 1 o'clock in the afternoon, which means you need price to be near the edge, whichever edge you chose, really late in the day. It can be sitting right on your target at 1 o'clock, and it might show that you're up 10 cents, which, hey, you made your $5 back. Yay. But it's not the kind of reward we're looking for, right? And then it's going to move away from that line. And then, you're frustrated because it was on the bullseye and now it's leaving and you don't have any freaking profit in the trade. It sucks. Believe me, I get it. So you needed to come back into that zone around, say, 3, 3:30, 3:45. That's when the trade is really going to start to bloom and show profit. You have to play chicken with the close. And that sucks because this trade has to be closed before the end of the day. You have one leg in the money, possibly two. You will get assigned and you don't want to be assigned. Even though it's a cash secured product, there's fees that come in and get that are a part of that process, and they love to give you those fees. And those fees are going to eat into your profits. So you have to get this trade closed. Some brokers offer market on close orders. It's called an MOC order. They are fantastic because it's exactly like it sounds, market on close. They promise, guarantee that your trade will close before the end of the day. You might not like the price that it fills, but it will fill, which is good because if you've tried to trade the SPX and then you've seen the options price bouncing around all over the place and avoiding you, and then you can't get out because it's moving so fast, you'll appreciate that MOC order, right? You'll know its value. It promises to get you out, and it will do that. You just might not like the price that it fills you at. So Thinkorswim has an MOC order. It's right there. Some brokers have it and some don't. If you don't have it, you could call them and try to do it over the phone. I don't know. I mean, good luck with Robinhood, as best I can tell you there. These 0-day trades, because they will be 0-day when we're trying to close them, even if you had them open for days. When they are on their last day, you have to be careful of some brokers who will auto close your trade, especially a butterfly, because a butterfly has legs that are in the money, which puts your account at risk, and they will liquidate that sucker. So know your broker, right? Make sure your broker isn't one of those that will come in and manually close your position at 1 o'clock in the afternoon, because this strategy will not work if you're closing it at 1 o'clock. It just won't. So if that's your broker, don't do this strategy. Get a different broker or get a different strategy, I guess. One or the other. So one of the strategies is putting the butterfly on the line. You have to get some trust that this system works to be able to have the stomach to come in and take those losses day after day after day after day. The best way I can get anybody to grow that trust is to show you how I grew that trust. And it's not just in this system. This is how I grow my trust in all of my systems. I go hunting for it, find it in the past, and then study the hell out of it. I capture it with pictures so that I can save it and look back at it later and I don't have to go hunting for it next time. And I analyze that with every new thing that I learn. I go right back to those old pictures with my new eyes and apply what I learned towards what I've already captured. So here's one example. And it has another example up here where we closed on the Friday level. There's some Friday levels, multiple Friday levels. Here's one on the red. So if I took a picture right here, I've got multiple examples of this. It would give me something to study. You want to find examples of your trade, right? That's the idea behind it. Day trading, swing trading, it doesn't matter. But if you don't know what your trade looks like, how are you supposed to find it? So in these examples, we would be looking to close on the line, understanding why we went up. Unfortunately, we're so far back in time that I can look at this and say, "Oh man, look at that was a gap day. We closed here and we gapped up here, and then we ran outside the box, came back in, closed on the line. What the heck was happening that day? Who knows? It's so far in the past. I don't have any context on why price acted that way. So that kind of sucks. If you can add to it, great. If you start tracking things from now going forward, you'll have that info, right? And you can add that to your database of analysis. No, I didn't stop because of the craziness of the market. I made it through my whole year. That was my plan, and that's what I did. I accomplished it. At the end of the year, I stopped all of the mechanical trades because I was tired of doing them. I did them nonstop for a whole year. I didn't get a lot of independent trading done that year because I was so busy cataloging and recording and documenting and tracking these trades. That's really what the bulk of my year was because I had so many of them that I was going on. I missed being a freelance independent trader that could just go in and willy nilly grab a hold of whatever I want. Hell yeah, it worked. I would not have run it, and I would not have done it if I didn't think it was going to work to begin with. And then when I got done at the end of the year, hell, I made money. There was no argument on that. Yes, it works. You do it. That's the point. There's no let's. I'm done with mechanical. I like being a freelance independent trader who picks and chooses their trades. But I'm not the one who sits here every day and says, I can't find a trade. I can't win a trade. I don't know how to trade. Because this is a new community of traders, right? We are full of people who are learning to trade every day. Well, guess what? If you can't find a trade, mechanical trades got you covered. If you don't know how to trade, mechanical trades got you covered. If you're losing trades frequently and you don't want to do that anymore, mechanical trades got you covered. I don't suffer from any of those three things. I don't need the mechanical trade. So, this is one strategy: butterfly on the line. Very simple. And you can lay out your own rules for how you want to do it. 1 day out, 3 days out, Friday, next Friday. There's so many ways to play it. Think it over, consider the possibilities, the cost, the broker that you use. Think through everything that we've already been talking about and kind of put all the pieces together because there's no special formula. Remember, Tuesday at 11, there's no special formula, right? So you can just put something together and let it ride, right? You can build your trust by applying this indicator and going through week after week and looking at how often we closed on the line or near enough to the line to have been able to profit from the trade, right? Because that's where the trust is going to come from. So, one strategy, since we've already got this indicator on, it's worth talking about another strategy. This one is dependent upon price doing something. What I like to focus on is what happens on Monday or Tuesday, maybe Wednesday. The Wednesdays, it's subjective, but not Monday and Tuesday. Monday and Tuesday is written in stone. It works awesome. The idea is this is the range for the week. And if we get to one edge early enough in the week, we're very likely going to go to the other edge by the end of the week. Or at the very least, when we get to one edge early enough in the week, we'll come back up off of that edge. The reason I want to say it that way is because if we go to the bottom edge, say on Monday, we don't want to necessarily buy a call. A call says, I think you're going up. What I am saying is, if we got to the bottom on a Monday or a Tuesday, we're likely done going down, not necessarily going up. I did find that if we get to the low edge early enough in the week, we very likely go to the other edge by the end of the week. That does imply we're going to move, but we don't have to. What is more likely, though, is if we reach the edge early enough in the week, we will stop going down and we will likely go up. So, short puts, not long calls, is what I'm saying. If we get to the top on a Monday or a Tuesday, short calls, not long puts. Now, this strategy requires that we're paying attention to where the lines are as price is moving during the week. So this is one of those examples right there. We hit the edge on a Tuesday, closed outside of it, really. And that was the end of the move. We came back in for the week. Now we traveled far enough that we could have bought a put. Selling calls would work, buying a put would work. I'm going to say you're more likely to profit from selling calls than buying puts. And the opposite would be true if we were on the bottom going up. Selling puts rather than buying calls. My drawing tool had decided to quit on me. You going to quit? Quitter. I think it just gets stuck with my multiple monitors and multiple computers. So I'm running 2 computers. It gets confused. Now this one doesn't have the strict guidelines that the other one has. We know exactly what we have to get with the other one, right? The butterfly on the lines. It's really simple. We just build the butterfly on top of the lines. It takes all the work away from you. You don't have to guess what expiration I want, what contracts I want, like none of that stuff really is left for you to choose. In this, it's more open. Do I want to buy the call? Do I want to sell the puts? What expiration am I going to use? What profit targets am I going to use? Right? There's a lot more usability. You have to make a lot more decisions in this one. My suggestion would be that you write your rules out for this one before you start trading it. Are you going to, buy calls or sell puts? Are you going to sell calls? What are you going to do, right? Lay it out in advance what your expiration will be, what your profit targets are going to be, and if the trade is losing, what your exit will be. Because there's nothing wrong with having all of that in advance. I did videos for my mechanical trades. They're on the Bullish Bears website. In fact, I did some public teaser videos that are on YouTube. If you just search for mechanical trade strategies, you'll find the teasers. Just, be aware they are teasers. There's no real insight into what I was doing on the public videos. But if you go to the Bullish Bears website, I laid out the strategies that I was doing and the rules and the criteria. It kind of gives you some insight into some rules that you could make. But this one works. But it's only a Monday, Tuesday thing, right? Once we get into Wednesday, it's less successful, and you definitely don't want to do it on a Thursday or a Friday. So it only has limited availability, right? So I'm not a huge fan of it since it's really just that Monday, Tuesday thing. Still, it's worth throwing it out there because just like me buying calls on Tuesday at 11, it's a strategy that I know works. You can choose to use it or not. This strategy does work. It just isn't so awesome because it's a Monday, Tuesday only kind of thing. So I guess if we had a different strategy that was only a Thursday, Friday kind of thing, it would balance itself out a little bit. But I don't have a Thursday, Friday strategy yet. Now I'm really far in the past here. We're looking at 2016. And the range in 2016 was very narrow. This is the whole week's range. It's 3 points. 3 points. That's not that bad. Here's a different random week. 3.5 points. 2.7, right? Less than 3%. So percentage wise, these are not big ranges, right? 3.5, 2.5. What we used to do back in the day is we'd run an iron condor for the whole range. And that worked out pretty good before COVID. We could do one of these and we could do it on SPY and get anywhere from 85 cents to $1.15 in a $5 wide iron condor. I know that doesn't sound like much, but the success rate was 75 to 80%, right? And when you can net more than 50% profit and you're winning that much, the strategy worked. Unfortunately, though, after COVID, the range got so wide that the iron condors we were building was only offering us like 25, 35 cents. You know what I mean? Like the range is just too big. Look at our current range here. Oh, can't see it. Let's try it again. It still says 3.3, but I'm going to argue the range is much bigger now, right? But you know what? We were talking about this a few weeks back, and I built an iron for the week, and it was offering around $1 something. So the prices are coming back. But right after COVID in 2021, all through 2022, and even into 2023, the the range was still too wide. The options were too expensive, and we was not able to run that strategy. So the fact that we can run it now, it's awesome. Maybe let's see. Let's see what we can run. We're gonna just build one out and see what we got. That'll work. 70.26 and 67.88. I guess that was a bit much. We don't need that many. All right, so here's 67.85. We're going to step just below that 88 and use an 85.80. If we have to, we'll move up and we'll use 90.85, which will put the 88 in the middle of those two. But, just to start the build, I'll start out. No, I'll just go ahead and straddle. Why not? Just do it. And the other side is 70.26. $2. That's pretty awesome. It's good to see that we're getting money back in these again. This strategy just might be back. We used to run this thing every week. It was awesome. But I miss it. Man, I miss it. So let's finish building it out. We're going to clear the blank because that'll be where the line gets drawn. Make sure there's no drawings already on there. Stretch it out a little bit. All right, this is the iron condor that I just built. We are risking $3 to make $2, and because it's a 1 standard deviation range, we have a 70% chance of winning this strategy. That's the math. Now, we're trying to keep it equidistant when we build the trade. So here is where price is, and it's supposed to be in the middle of these two break evens. What a lot of firms do during the week is if price moves down, they'll roll their position to keep it balanced in the middle. Or if price goes up, they'll roll their position and to keep it balanced in the middle. We're not going to do that, right? I just thought I would throw that out there. They remain delta neutral the whole time. we're going to try to build delta neutral and then just let it roll, right? Stinky monkey style, but that's just what we got. So in this scenario, what we want to do is mark our break-even line so we can check to see, are we straddling these levels, or do we need to readjust the strikes a little bit up or down? So we're going to set the slices to break even. That puts these two gold lines on there. And then we're going to set those slices on the chart. And that gives us this, right? Which oddly enough, it didn't. Oh, I'm on the wrong one. There we go. So we can see from the lines here, we did a pretty good job. You can't even see that red one. It covered it up perfectly. The green one, it's just barely poking out, but it's good enough. So we need price to stay within this range next week, long enough for this trade to decay and for us to make profit. You don't want to run it to max profit. I know it's tempting, but the less time in the trade, the more violent the options price moves. So as it nears expiration, small moves in the market can radically affect the price of the options. And that's not what we want, right? We want this thing to decay nice and easy. And then we just jump out along the way. You can aim for 50% profit as a good start on the model. But don't be afraid to take profit early. Say headlines come out and kind of shake the market up and you're up, 35%, take 35%. If you wake up tomorrow and your trade is up 62%, don't get upset about it. You was, aiming for 50, you made 62. So what? Get out at 62. I've got a line in the sand on time where I don't like to be in these, later and later and later in the week. It used to be Thursday morning, I would be looking for an exit. Now, I can't say that system is going to still work today. I'm going to have to run these for a couple weeks myself just to see what the new line in the sand is. It might be Wednesday afternoon. It might be Thursday afternoon. I don't know. But we don't want to overstay our welcome. Now, if you're looking at this average implied volatility, and your broker is different than my broker, that number is going to be different, right? One, the market is still alive. Two, we're not at the end of the day yet. The closer to the end of the day we can get, the better. But the idea is that these brokers, they don't have any obligation to match what another broker is doing. And the formulas that they use to get these numbers are different. Even with Thinkorswim, we know some of the formula, but it's proprietary, so that we don't know all of the formula. It has the square root of time, and it has the out of the money options implied volatility, and it has the effects of the lot size and the tape speed. But that's as much as we know, right? And I'm sure there's more to it than that, but so they won't match from broker to broker. When do we put them on? We want it as close to the end of the day as we can get. But there's a little bit of a problem with that. It's 4 strikes, right? And that means it's going to be hard to fill. And they're out of the money a considerable amount. It's not like we're hugging price, right? And that's going to make it even harder to fill. So you want them filled as close to the end of the day as possible, but you also want them to get filled. And if you wait and you don't get filled, then it sucks. And yeah, we are talking about a Friday to Friday trade, but when we were running this before, we didn't have Monday, Tuesday, Wednesday, Thursday, Friday. We had Monday, Wednesday, and Friday. And we had found back then that Fridays was the best choice. But it's a completely different world now. I didn't even know that these were pricing good enough to be able to put them back on again. We also have newer products too, like the XSP, which is the micro version of this, and it's less liquid. You'd probably have to fill that by running the put side first and then adding the call side or something like that, right? Like it'll probably be even harder to fill it on the XSP. Liquidity is certainly king. You want as much liquidity as you can get. The one constant, however, is where we are targeting, and we're targeting next Friday's expiration. Now, you can on this Friday, you could use those levels and try to build one for Monday and Tuesday and Wednesday and Thursday. But will you get enough cash? Right? Because we can build this. We've always been able to build it, but I stopped running it because there wasn't any damn money in it. I didn't want to risk $5, make a $5 wide iron condor and collect 20 cents for it. Hell no, I'm not risking $480 for a chance to make $20. Because remember, we're not even going to make the $2 that we were looking at. We're only going to make maybe 50% of that $2 that we was looking at. So if there's yeah, but that's not me. Not me. I refuse. So you could try to do it on a Monday, Tuesday, Wednesday, Thursday, but I don't think you'll find any money in it. I was going to copy that trade, but I guess I don't have to. We already have, uh, I guess I did need to. It's with me today pushing the wrong button. Boy, oh boy. If we did it on the 23rd, which is Monday, it's 30 cents. If we did it on Tuesday, it's 50 cents. Wednesday is 70 cents. Thursday, oh, I guess that's Friday. I must have skipped a day somewhere in the way. It's down to $1.55 now. The more we talk about it, because price is moving, it's likely going to get cheaper and cheaper. But price is moving, and that means we very likely need to move the strikes. Right? They look like they're still lined up. But yeah, that's the iron condor strategy. Now I still like the Marcus trade that I built to solve the problem of the iron condor that wasn't giving us enough money. That's the one that I laid out a few weeks back where we used the double diagonal. The problem with the double diagonal is it just confuses the hell out of new traders. I already did it. I covered it at the beginning of the stream. So if you missed that, you just have to catch the recording. No, no worries. It's um it's always fun to talk about that, but um so I love it. Ask away. But yeah, I already did it. Just catch the replay. The good thing is it only took like 10 minutes and it's right at the beginning. So you'll be able to just catch today's replay and catch the first 10, 15 minutes of it and should be good. For double diagonal, I'm pretty sure I mentioned it in the Discord. Yeah. Let me poke. Actually, I want to stay in this Discord so I don't. The double diagonal is fantastic. I love it. And it has so many possibilities to change it and make it into something else. Because a diagonal uses two different expirations, and it's that other expiration that gives a lot of leeway. Well, unfortunately, it looks like I didn't label the stream, or it would have showed up there. But it wasn't that long ago. So just look at what I wrote, and then hopefully I mentioned something about options trades or mechanical trades in the title, because it'll be one of those titles, right? It was something about mechanical trades and double diagonals. So, man, that sucks. I didn't get it titled. And this, if Jade Lizard growth versus value, that was a day that we talked options. Probabilities, anything that mentions probabilities, those are the days that I usually end up talking about mechanicals and iron condors. So that one too. Probability based trading strategies. I'm feeling pretty good that it was that one. January 23rd. Yeah, on the Marcus trade, the double diagonal, that's on the website too. So the good thing is the how and the why, it's all on the website. So you'll be able to do that one and the mechanical. They're both on the website. The backdrop is for this trade strategy, these lines is the amount of money that the market puts into trading these levels and the history of it. To be able to go back in the chart and look at years of data where price closes inside these lines and then closes on the lines at the end of the week, especially like on a Friday afternoon, if we're near one of those lines, to watch price on a Friday afternoon just drive to that line and get pinned on it, it's so cool. Knowing that they exist and watching it happen in real time, it's addictive, which is what caused me to really want to trade on them levels, and to try to come up with strategies that could profit from it. That weekly expected move indicator is how we also are able to spot things like a sideways week that is coming up. We don't have one this week, but if you're looking at it on a week to week basis and you have a week coming up that's really narrow compared to the weeks that you've been seeing, that tells you that the next week the market is anticipating a sideways week. That means breakouts will fail more often than not. So if we even test yesterday's high or yesterday's low, if we even get there at all, your reversal trades are going to run at a much higher success rate. Unfortunately, next week's range is not one of those weeks, but it's one thing that I look for every week. right? I talk about it in the morning briefing on Fridays and on Mondays, how that's what we're looking for, right? Is to find a week that is much narrower than our current existing week, because that tells us, hey, next week we're likely to see a hurry up and wait week. And one of my favorite trades is trading yesterday's 111, right? It's a reversal play, it's a breakout that fails. I love a breakout that fails. So I like finding those kind of weeks. And you can trade them with options. If you don't trade futures, you don't have to. You can trade those days with options and it's still running at a higher conviction when we have that week, right? And that's the problem. When you don't have that week, then you don't have that trade. We don't want to force the issue though, right? So I look and I see if it's there. And if it's not, then all right, fine, it's not there. You'll find it more often than not when it's an economic event week. CPI, PPI, non farm payrolls, FOMC. Those are often weeks where on the Friday before, we'll see the very narrow range for next week because the economic calendar is the reason for the narrow range. And so that's what we anticipate. But we're in a wide range environment, and that's because we're still in a negative gamma environment. So the range is just really big, and there's nothing we can do about that, right? It's not there, so we just move on and focus on something else. If you use this indicator enough, you'll come up with all kinds of ways to be able to use it. Not necessarily. It's a forward logic, right? Like on Fridays, if you're looking ahead to next week and you're trying to figure out, say you've got some yard work to do, need to build a fence or something, and and you're a breakout trader, for an example, stocks, options, you like to trade breakouts, and you notice next week is a narrow range week. All right. Well, then next week probably won't offer you a lot of breakout opportunities. Probably a good time to go ahead and build that fence. But if you look at next week and it's a wide range week and you like breakouts, well, you're more likely to see a breakout that follows through in that wide range week. The problem with breakouts, though, is that just because the range is wide, it doesn't mean you're actually going to get that breakout. It just says that the range is wide and price could move to the edge of that range. Doesn't mean we're actually going to get a reason to move, though. Because remember, they're anticipating that price is going to need the space. But if it doesn't need the space, it doesn't make the move. The narrow range is based on the economic calendar. When the market knows that next week is an event week, like CPI, PPI, non-farm payrolls, it will anticipate that we're going to go sideways for at least 1, maybe 2 days, and that's why we end up with a narrower range. Like economic calendars are volatility suppressing. And so that means movement is suppressed because volatility is another word for movement. So that's why we end up with a narrower range. It's simply because the market says, oh, if next week is FOMC, we're probably going to go sideways Monday and Tuesday because who wants to trade on Monday and Tuesday in front of an FOMC week? Nobody. And that means narrow range, which also means we're likely to fail if we try to break out. But we can't really take that logic and apply it willy-nilly all over the place because it has to fall back into why do we have a narrow range next week? CPI, PPI, non-farm payrolls, that's why they would project a narrow range. If it's just by coincidence, you happen to see some random market that has a narrower range next week, like BMY, then you'd have to go in and check with BMY and see why does it have a narrow range next week? Do they have an investors day conference? Do they have, earnings, or what economic thing do they have that's causing them to perhaps have a narrow range week? And here is BMY, and I'm looking at its week, comparing it to the week that we just have, and it's not a narrow range week. It's no different than the week that it just went through, or the week before that, or the week before that, which was an earnings week. So it doesn't even have a narrow range week. That doesn't mean it's going to break out. It doesn't mean that it's not going to break out. And the breakout that I was referring to was on a day-to-day basis. When SPY gets to the edge of yesterday's high or yesterday's low, what's the likelihood that it breaks out and it keeps on running? Well, on a narrow range week, it's more likely that the breakout will fail and that it will come back in again. So it's not breaking 52-week highs or the monthly highs or some line on the chart. It's just breaking yesterday's high or yesterday's low. So here today, for an example, in SPY, we can look, it broke yesterday's high, and so far it's still outside of yesterday's high, just barely holding on by its fingernails, but it's still out there. That's the kind of breakout I was referring to, just a breakout of the previous day's high or low. I like to trade failed breakouts in options and in futures. And I will trade those as a failed breakout, even if it's not a narrow range week. I will anticipate that we're going to fail more often than we're going to succeed because, well, that's what the numbers say we get. Breakouts fail more than they work. And if you just trade the odds on that, you will win more than you lose simply because of the numbers don't lie. But on a day-to-day basis, we can also just approach it with, hey, what should happen today? And we line that up in the pre-market in the morning briefing. I don't get it right every day, but I'm getting pretty good at spotting in the pre-market that I think today is going to be a breakout day or not a breakout day, and whether or not it'll even be a tradable opportunity. And that's good to know, so we don't sit in front of the computer all day trying to get a trade that never even shows up, because that sucks. What I just measured here was yesterday's high and low. There's our 111 reversal. There's our 1236 reversal. The 1236 came all the way back to the half, which is really nice. And then, of course, a reversal off the low. We didn't even get a breakout down there. I love this trade. Then the liquidity gap, which, I talked about it at the open. It's not a normal liquidity gap, and it went kind of the opposite way because we left participants up at the top and had to go back up there to play save a hoe. Yeah, it's like they're defending it, took a front run on it. The good thing about that sort of behavior is you should see it in the dome, right? You should see it in the active trader. Which is the same thing that I was talking about at the open. I traded the first reversal here, this leg. I got that one, but then I got busy and I missed this one. This second one was so beautiful. I was a little salty about that. But I mean, the first one worked out really good. I don't have any complaints. It's just, man, that second one was even better. In this situation where we already had the high and we were looking at price to come up and reject that high and then fall, what you want to watch for, and I should have brought up like my trade evade or something. You want to look for the orders here to be really thick, right? Really thick, because that's going to stop us from getting through that level, right? Really thick orders. But if you're watching it and it's thick and then it starts to thin out, we're going to go through it, right? Because they're clearing a path. They're going to run through it. The same thing once we get up there and we've got 1 bar, 2 bar, 3 bar, start looking down on this side and look for those numbers that thin out. If it's usually three digits, then look for 2. If it's usually 2 digits, look for 1. Those single digits are warning you that it's getting really thin, like walking on thin ice, and then it's just going to break through it and down we go. There's nothing to hold it up. Right. Yep. Um, TradeEvate used to be partnered with um, Jigsaw. And so TradeEvate built some of the order flow tools into their platform, which is really nice because for people who don't have Bookmap or Jigsaw, it's just it's nice to know that you've got some access to those sort of tools without having to go and buy those kind of tools. I like Bookmap. I think it was money well spent. Bookmap, Jigsaw, whichever one you have. I have Jigsaw, but whichever one you got, it's worth the money if you're day trading or taking trades today that might last into tomorrow, that sort of thing. They're not really useful for swing trades, 10, 12, 15-day kind of trades. It's just not useful for that. But intraday, oh yeah, just sign into paper here. So it's got some order flow tools built into it. One of them being time and sales with a filter. I know it doesn't sound like much, but being able to filter the time and sales is really helpful. Let's just set this one over here. Let's spread it out. Widen out. Give me some room. And we'll put another, see what this one is. Yeah, that'll work. All right, so one of these filters is set to 0. One of these filters is set to 17. You have to move the mid-size filter. I move it based on how fast it's moving. So right now it's moving multiple times a second, but I can still read it. All right. So if this one starts moving too fast and I can't read it, I'll slow it down. If we're looking at it and it hasn't moved for over a minute, then I'll uh, move the numbers to where it starts to move again. Right. So we want the bigger one to move, but we want to be able to read it. This 0 one, we don't even try to read this one. That's just color. That's all we want to use it for. Notice the black background with the green writing. That tells us that orders are coming in, but price isn't moving. All those right there. All those were buy orders and price didn't move. The black background with the red writing is also orders and price didn't move. So if we tick up into a new level, we get the green background and white writing. Once we're at that level, if we're filling more orders but price don't move, then it'll be green with a green writing with a black background. So those colors are color coded to tell you what's going on. You don't want to read these though. The zero filter is not for reading, it's just for watching, because that's tape speed. How fast are the orders coming in? So it's going to turn red and it's going to turn green and it's going to flash by really fast. The black stands out really nice. And if it's green and black like that, I know buyers are hitting, price ain't moving. We can tally it up since I took a picture, and we can see that a total of 46 buy orders came in, and price still ticked down on the other side of that when it was all done. We ticked down, and then we started getting sell orders, but price wasn't moving. So that's just watching the tape, not even reading it, just watching it. We want to see these orders when they're coming in. We want to see if it stops. And that's kind of scary as a trader when you're watching this and suddenly it just stops. Like the whole market decided to hold its breath and nobody's taking a trade. And it's just really weird. But oftentimes that pause will happen right before a big market move. And then suddenly price is ripping like crazy. And it's just a roaring flood of orders that come in. So we got one of these that's showing us the pace of the tape, the speed of the orders as they're coming through, and generically if they're buying or selling because of the red and the green. But really just watch it for the speed. And you can kind of spot size in there a little bit, but that's not the goal. Don't bother reading it. You read the next one. That one is your mid size. It's not your big block orders, but it will find those. This one's more about the average mid size order. And as you can see, these mid size orders, they're coming in 30 or 40 of them a minute, right? There, it's a pretty good steady pace. In the pre market, you might have to knock that down to like 10. And if you're watching it at the open, you might have to knock it all the way up into the 50s before it starts to slow down enough for you to read it. But it's adjustable through the day. You want to adjust it to where it is moving, but you don't want it moving fast enough that you can't read it. You want to be able to look at the orders that are coming in with size to have some understanding of the orders that are coming in. So that's the tape. And then we got the dome and that thinness and thickness that we're talking about. So that if we're looking at a level that's getting defended or is possibly going to be defended, like when we draw the fibs and it's the 100 line, price drops down to the 786 and then it starts to rise back up towards the 1, and we're wondering, are we going to break through that 1? And then we see the orders being defended. We got a better idea about whether or not price is going to make it through that level. So this would be a good example of that. The 100 is 24. And of course, we got some of that order flow here on the side, but these candles are too big to use that. But we would watch 24 as price came up into it, and we'd watch the side here to see if the numbers start to thin out ahead of that move. They're double digits. So thin would be single digits starting to appear in here. And the big blocks like that would disappear. There wouldn't be that sort of resistance over our head. And when it starts to get thick, then we know they're getting to the point where they're trying to defend that level. That doesn't work very well, by the way, if you're using the NASDAQ and you're trying to use order flow, good luck. It doesn't work. That was a little disappointing when I bought Jigsaw. I was only trading the NASDAQ back then, and I was really disappointed that order flow tools like Bookmap and Jigsaw really they're not very effective on the NASDAQ. It's too janky. It's bouncing around all over the place. I can say it's liquid. It is very liquid. More, especially if you're on the MNQ. That thing is more liquid than all of them. But it jumps from, point to point, just 6 ticks at a time. That thing is wild. And that means it's leaving thin gaps all over the place. So order flow, not so exciting when you're trading the NASDAQ. Yeah, look at the MNQ. 2,144,000, 145,000. So 2.1 million contracts traded on the MNQ compared to the ES with 1.6 or the MES with 1.6. You know what I mean? Like the MNQ is the most liquid one of them all. But you wouldn't notice the way that that thing bounces around all over the place looking at the order flow. So look at that. This is just all over the place. And it's already really thin. So those tactics, you would just have to get used to reading it really fast, I guess, and maybe put it on its own screen or have it auto center itself. I don't use the auto center. Yeah, it's too janky. But you can still use the pace of the tape. That works on everything: stocks, options, futures, all of it. So when we go to approach the edge, you can watch the tape, try to see if they're pulling and stacking, defending the level. If they're trying to spoof, which technically is illegal, but they'll do it anyways. They're just trying to defend that level, and they'll front run it like they did here, where we didn't actually get up there. They put in defensive orders and ran it back the other way before we was able to get to that level. We was going to get into some back testing stuff, but I was talking to somebody about Options Omega, and it's not a free service. So, it's hard to bring up something like this, knowing that if anybody wanted to use it, they'd have to go out and get a subscription to it. Don't get me wrong, it's absolutely worth it, but it's yet again another thing that you'd have to pay for and then learn how to use. And learning it's not really that bad. And they've got a really awesome Discord full of people that use it all day, every day. So that's cool. So you made $1 a day. But did you compound the size of the trades the way it does? And you didn't compound it and make it bigger and bigger and bigger and bigger. Yes, sir. I agree with that. Yes. See, and I like the fact that you can do that, because when I want to check how it does in bear markets, I can go back to 2022. If I want to see what it does in extreme markets, I can go back to COVID. Like I took that as a positive, you know. Exactly. And see, this is what I keep trying to highlight to people. You have to trade based on what you have now, right? But if we can't identify what we have now, then sit the hell out. You know what I mean? I've been hammering this home for years. If we're in a sideways market and we're not doing jack shit, sit the hell out. Stay out of it. And no, people refuse. Yep, absolutely. So in those back tests, we can use it. One, this is what's really, I like this. You can black out dates with that back tester, which is so awesome because I don't like trading short weeks and I don't like trading FOMC weeks. So when I was running my back test, I marked out all holiday weeks that were short weeks. I marked out all FOMC weeks, especially FOMC days if I wanted to get more specific. And I could mark out things like QRA events and make sure that the back test didn't put trades on for those particular days. I was going to do things like CPI and PPI, but it just got, you know, the list of days that I wasn't allowing it to trade was getting to be quite large, and that I just, gave up on that. But it was cool that you could, right? You could mark all of those days until it run my back test, but don't trade those days because I know personally I wouldn't trade those days. Then you look at the market that you're in. And if you're in a market that's bullish, like we were, say, when we came out of these lows in April, and we were just bullish all the way back up, then you can run the back test on a bullish market backdrop. Or if it's 2022 bear market and you know you're in a bear market, like we all knew in 2022 that it was a bear market, you go in and you run back tests for a bear market environment. You know what I mean? Like target what you got. Screw the whole generic, I want to test the last 10 years kind of thing, because you're right. We don't trade that way, right? At least we shouldn't. We should look at what we have and trade what we have. We should trade bullish markets. We should trade bearish markets. But when we ain't got jack, we shouldn't trade it either. Now, I'm not saying that there is nothing to trade because, man, there is lots to trade. There is. And we can trade sideways, which is cool. But we have to target those back tests to match what we have. Right now, we don't have any forward guidance from the Fed, which means swing trades are out of the question. If you do a swing trade, it can't be based on market principles of, like, the S&P and the Nasdaq and the Mag 7 being buoyant. You're going to have to trade based on this one particular company, say Open Door Technologies, for an example. This one particular company has turned around its business model and just had earnings that shocked the world, and it's now probably going to head up to $11 and plus some. It's going to come back and challenge these old highs. This is a turnaround company, right? Like a fallen angel. The entire narrative of this company has changed, and it doesn't matter what the rest of the market is doing. It doesn't care about war and the Supreme Court decisions and none of that stuff. As long as people are still buying houses, this company is going to do good. That's a narrative. That's a story for this one market, and I can find a trade based on that story and that narrative. So there's always something to trade, but I couldn't backtest that. regular week. I am going to duck out too. Check out the Bullish Bears. I have those mechanical videos here. You should be able to just search mechanical and find it. I'm going to log in and point you guys in the right direction. So you want to go to Next Level Library, Options Trading. Then I have to look because even though I made the material, I didn't make the website. And when Lucian and the team was making the website, they wanted things that would match Google searches. And people really don't Google search mechanical options. So they would name the title of these based on what they thought people would Google and not necessarily based on what the title of my video was. And that means they don't always land where we think they would. So I'm just going to poke around and try to find where they got stashed. I did run a whole school of topics. 3 different schools are in here. There's a volatility school, and then there's the advanced options course, which is what all of these are. And then on the public YouTube is the regular options course. But we're looking for the mechanicals. I'm telling you, I'm not seeing them. Well, there's the aggressive mechanical SPY strategy. That's it, just that one. Now A2 didn't bring up anything. But like I said, they didn't name things the way that the video was named. That's got 2 T's in it. It might be, but I just did a search for A2 and I didn't find anything. I'll ask Lucian what he did with him. Yeah, I mean, the mechanical ones that I'm looking for, they're on the site, at least they were. And the only public ones that I did was teasers so that people could see the teasers and come watch them. If they're not here, I might have copies because I remember at some point the we were talking about how the titles of these don't match the title that I made in the video. And he was asking what video should go where. We used to have like a carousel of videos. It was a different format. And when he changed the way that this website looks, he might have removed them. And if that's the case, then I'll just have to dust them off and bring them out of storage. I have probably have every video that I made for the Bullish Bears, and that means I've got the videos somewhere. And if I don't, it's possible that I could recreate it, but it would suck. I'd have to find all of that old data. I mean, I kept it for at least a year, but it's been 5 years. I don't even know where it's at anymore, if I have it at all. Yeah, I don't see it. So I'll dig around and see if I have them. And you can check that A2, whatever that is. But the main thing is that I'm just not seeing them. It should have been in the next level library. And but I don't know. I know. I know, but I don't know. A, I don't know what the hell A2 is. And B, I don't know where it is because I'm poking around and I'm not seeing it. I ran a search at the top and it didn't find it. So I know this sucks because I used to be able to just come right in and go to that spot on the website and go right to those videos. And now I can't. So makes me wonder where the heck they're at. How to chart the expected move. I have an expected move indicator called the weekly expected move. I've shared it like with everybody everywhere, but if you want it, get it here. If you're not using Thinkorswim, then you need a broker that has options and it has the implied volatility average on the options chain. So you wait for the market to close to have the weekly options. The market needs to close and the numbers need to quit moving. Here it is after the close, and you can see the SPX. These numbers are no longer moving. So you go to next week's options, and the SPX, well, the SPY has a $13.60 expected move. So from the close price, add $13.60, and from the close price, subtract $13.60. That's next week's expected range model. That's where your expected move is. That way, if you're not on Thinkorswim, you now know how to do it. These numbers very likely are going to continue to shift until at least 4:30, maybe 5 o'clock. So what I recommend to people is on Fridays, if you want the weekly expected range, let the market close for at least an hour because the dealers are doing things behind the scenes and so are the brokers, and you might see these numbers shift even though the market is closed. So give it some time, even come back on like Saturday or Sunday night, something like that. But if you come back Sunday night, do it before 6, right? Like do it before 5. Get in there around noon or so, because if we get too close to the open, these numbers are going to start to move again. But those numbers, because it's 7 days out, right? That's next Friday. If you want the tomorrow options, then you do it in the 1 hour period. Like if this was Thursday afternoon, then you would wait until 4:30 or 5 o'clock, and then you would come in and grab tomorrow's levels and mark them out. Otherwise, use that indicator and it will mark the levels for you. Now you can hand draw those levels, or you can use the Thinkorswim system. So, just take this over to SPY. This range can be set to a 1 standard deviation. Go in here and reset everything. Use the calendar up at the top. So I want next Friday's expiration. The gray box here is what we need. Just get rid of that trade. Set the slices to base and 1 standard deviation, that level right there. That'll move these lines to the edges of the box. And now you can set those lines on the chart. There is next week's range and our close, which we don't need our close. There's the next week's 1 standard deviation. Oddly enough, well, not necessarily oddly enough, but notice that is not these. See how it's bigger? There's our weekly expected move, and there's the levels that it just drew. And that's because one is based on price action and one is based on options action. The red and green lines were based on dealer positioning and options that were traded. These 2 white lines that we just drew is based on the price action of the market over the last week and is anticipating what a 1 standard deviation of price action would be. So different model. Still is pretty cool. You can have both. I believe I made an indicator at some point. You could look in the Thinkorswim workbook that will do the daily expected move range for you so that you don't have to go in and calculate each day's expected move. Minthor Q has a daily level math, and Spot Gamma has a daily level math. I'm not a big fan of the daily level math. I'd rather use the ADRs, which is what I do use. But I mean, it doesn't hurt to see, what the market is priced in for the day. And it's just called expected move. So you should be able to find expected move indicators in the Thinkorswim workbook. And the link that I shared is the weekly one that I always use. I have like 10 of those in the workbook. Some have a cloud, some count how often we broke out versus stayed inside. Like I've got all kinds of indicators, but this is the one that I use. No clouds, no counting, just the lines. Nice, clean, simple. But I made fancy ones because I could. That's as good as I got because I could.